New York City, April 1952, Prudential Insurance Company headquarters. Nat King Cole sat across from Thomas Whitmore, a senior life insurance underwriter. Nat was 33 years old, in excellent health at the peak of his career. He'd come to buy life insurance to protect his family. It should have been straightforward. He had the money, he had the health, he had the stable income, everything insurance companies claim to want in a client. Whitmore reviewed Nat's application, medical examination results, financial statements, career documentation. Mr. Cole, your application is very strong, excellent health, non-smoker, stable profession, substantial income, so we can proceed with the policy. Whitmore shifted uncomfortably. Unfortunately, after reviewing your file with our actuarial department, we're unable to offer you coverage at this time. Unable to offer coverage. Why? Our underwriting guidelines indicate that individuals in your demographic category present elevated risk factors that fall outside our standard coverage parameters. Nat understood immediately what demographic category meant, but he asked anyway. You mean because I'm black? Whitmore looked down at his papers. Our actuarial tables are based on statistical analysis of mortality rates across various population segments. The data indicates you don't want black clients. That's what you're telling me. Mr. Cole, this isn't personal. It's actuarial science. Insurance is fundamentally about risk assessment based on statistical probability. I'm 33 years old. I'm healthy. I don't smoke. I don't drink heavily. I have a stable, lucrative career. What statistical probability suggests I'm too risky to insure? Whitmore had no answer that wouldn't expose the racism underlying the decision, so he deflected. I'm sorry, Mr. Cole. The decision has been made. We cannot offer you coverage. Nat left Prudential's office with the understanding that this wasn't going to be as simple as he'd thought. Before we dive into how every major American insurance company rejected Nat King Cole despite his perfect health and substantial wealth, how insurance industry actuarial tables explicitly categorized black men as uninsurable risks regardless of individual circumstances, and how he finally got coverage from a British company at triple the normal premium, while white entertainers got standard rates from American insurers. Let me ask, where are you watching from? Drop a comment, because this story about systematic discrimination in death protection is as relevant in 2026 as it was in 1952. The insurance industry in 1950s America operated on actuarial tables, statistical charts that calculated life expectancy and risk factors for different population groups. These tables were supposedly objective, scientific, data-driven, but they were built on racist assumptions. The tables divided populations by race. White males, Negro males, white females, Negro females. Each category had different baseline risk assessments, different premium calculations, different coverage limits. The Negro male category was classified as higher risk across the board, not because of individual health or lifestyle factors, but because of race itself. The justification was statistical. Insurance companies pointed to mortality data showing shorter average lifespans for black Americans, but they ignored why those disparities existed: poverty, inadequate health care access, occupational hazards from discriminatory employment, stress from systemic racism. They took the outcomes of racism and used them to justify more racism, called it actuarial science. Nat King Cole didn't fit the stereotype their tables were built on. He wasn't poor. He had access to excellent health care. He worked in entertainment, not dangerous industrial jobs. He was healthy, successful, wealthy, but the tables didn't account for exceptions. Black male equals higher risk, no individual assessment, just category. After Prudential rejected him, Nat tried Metropolitan Life. Same result. The underwriter at Metropolitan was more direct. Mr. Cole, our company policy is to decline coverage for Negro applicants above certain coverage amounts. For someone of your income level seeking the protection you're requesting, we simply cannot accommodate. What coverage amounts do you approve for black applicants? Typically, policies up to $10, $0. Your application is for $500, $0. That's well outside our guidelines. Why the limit? Risk management protocols. The actuarial data suggests the actuarial data is based on racial discrimination. Nat interrupted. You're not assessing my individual risk. You're categorizing me by race and applying blanket restrictions. I understand your frustration, Mr. Cole, but these are company-wide policies. I don't have discretion to override them. Nat tried New York Life, rejected. He tried John Hancock, rejected. Equitable Life Assurance, rejected. Travelers Insurance, rejected. Every major American insurance company gave him the same answer: we cannot provide coverage. Or in cases where they'd consider minimal coverage, the premiums were astronomical: $25, $0 annually for a $100, $0 policy, when a white man his age would pay $3, $0 for the same coverage. The pattern was clear. This wasn't about individual risk assessment. This was systematic exclusion. By late 1953, Nat had been rejected by 7 major insurance companies. He was one of the highest paid entertainers in America, black or white. He was healthy, he was responsible, he wanted to protect his family, and he couldn't buy life insurance. Maria watched him deal with rejection after rejection. There has to be someone who will insure you. You're not asking for charity. You're offering to pay substantial premiums for coverage. American companies won't do it. Their actuarial tables won't let them. I'm categorized as uninsurable risk based on race alone. What about international companies? That question led Nat to Lloyd's of London. Lloyd's of London was different. It was a British insurance market, not a single company. It operated on a different model, individual underwriters assessing specific risks rather than rigid actuarial categories. In early 1954, Nat's financial advisor contacted Lloyd's on his behalf, submitted his medical records, financial documentation, career information, made the case for coverage. Lloyd's underwriters reviewed the application, and they agreed to provide coverage, but at a price. The premium for a $500, $0 life insurance policy for Nat King Cole, age 34, non-smoker, excellent health, $15, $0 per year. For comparison, Frank Sinatra, same age, same profession, similar income, also non-smoker, was paying approximately $5, $0 per year for equivalent coverage from an American insurer. Nat was paying 3 times the standard rate, not because of worse health, not because of riskier lifestyle, because Lloyd's calculated that insuring a black American, even one of Nat's profile, required premium adjustment to offset what they perceived as elevated risk. It wasn't as overtly discriminatory as the American companies that flatly rejected him. Lloyd's was willing to provide coverage, but the pricing revealed the same underlying assumption: black life equals higher risk equals higher premium. Nat paid it. He had no choice. Lloyd's was the only option. $15, $0 per year was a significant expense, equivalent to over $150, $0 in today's dollars. But protecting Maria and the girls was worth any price. What made this particularly galling was knowing that white entertainers faced no such barriers. Nat knew Frank Sinatra, knew Dean Martin, knew Perry Como. They talked about business matters sometimes. Insurance came up in conversation. Sinatra mentioned his life insurance casually: $500, $0 policy, paying about $5, $0 annually, got it through Metropolitan Life with no issues. Dean Martin had similar coverage, similar rates. Perry Como likewise, all American companies, all standard rates, all straightforward approval processes. Nat said nothing about his own situation. It was humiliating. Here he was, earning comparable or higher income than some of these white entertainers, and he'd been rejected by the very companies that eagerly insured them. The financial impact was substantial. Over the course of his policy with Lloyd's, Nat paid approximately $180, $0 in premiums, 1954-1965, 11 years. If he'd received the standard rate that white entertainers got, he'd have paid approximately $60, $0 for equivalent coverage. The racial premium cost him $120, $0, over $100,000 extra paid purely because of his race. That money couldn't be invested, couldn't grow, couldn't compound. It was a racial tax on protecting his family, and the insurance companies that rejected him, they faced no consequences, no lawsuits. The legal framework for challenging insurance discrimination barely existed in the 1950s. No public pressure, most people didn't know this was happening. No regulatory penalties. Discrimination was largely legal in private commercial transactions. They just kept doing business as usual, insuring white clients at standard rates, rejecting or upcharging black clients, calling it actuarial science. When Nat died in 1965, Maria received the $500, $0 from Lloyd's of London. The policy paid out as specified. In that sense, the insurance worked. But going through Nat's financial papers after his death, Maria discovered documents he'd kept from the application rejections. Letters from Prudential, Metropolitan Life, New York Life, and others. All with polite, bureaucratic language explaining why they couldn't provide coverage. She also found notes Nat had made comparing his insurance costs to what other entertainers were paying. He documented the disparity, written down the numbers, calculated what the racial premium was costing him. He'd known exactly how much extra he was paying for being black, and he'd paid it anyway because protecting his family mattered more than pride. The late 1960s and 1970s, as Maria became more involved in civil rights advocacy, she began speaking about Nat's insurance struggles. She framed it as part of broader systematic discrimination that affected every aspect of Black American life, even death protection. Nat couldn't get life insurance from American companies that happily insured white entertainers with the same career, same health, same income, she explained in a 1973 interview. They literally looked at his race and decided his life wasn't worth the same risk calculation, and then they called it science. Her advocacy, along with that of other families facing similar discrimination, eventually contributed to pressure for insurance reform. The Civil Rights Act of 1964 prohibited discrimination in public accommodations, but insurance remained largely unregulated in this regard until later reforms. In the 1970s and 1980s, by then Nat had been dead for years, the reforms came too late to help him. The broader context makes this story even more troubling. Insurance discrimination wasn't rare, it was standard practice across the industry. Black Americans seeking life insurance faced systematic barriers, flat rejections, coverage caps regardless of income, premium surcharges. Requirements for additional underwriting that white applicants didn't face. The justification was always the same, actuarial tables showing higher mortality rates for Black populations. But those tables reflected the outcomes of poverty, healthcare discrimination, occupational hazards, all products of systemic racism. Using those outcomes to justify further discrimination in insurance created a vicious cycle. Black families couldn't afford insurance or paid. Inflated premiums, reducing their ability to build wealth and provide financial security. That economic vulnerability then contributed to worse health outcomes and shorter lifespans, which reinforced the actuarial table's classification of Black lives as higher risk. The insurance industry profited from this cycle while claiming to be objectively assessing risk. Nat King Cole's case was unique only in that he had the wealth and profile to expose the absurdity of the system. Here was a man who, by every individual measure, health, income, lifestyle, stability, should have been a perfect insurance candidate, and he was still rejected or upcharged based solely on race. If someone like Nat King Cole couldn't get fair treatment, what chance did average Black Americans have? The answer, almost none. Most couldn't afford Lloyd's of London prices. Most couldn't absorb triple-rate premiums. Most had to go without life insurance, leaving their families vulnerable. That vulnerability had generational consequences. White families could protect their wealth through life insurance, ensuring financial continuity across generations. Black families often couldn't, making them more susceptible to economic disruption from a breadwinner's death. This contributed to persistent wealth gaps that continue today. The inability to access affordable life insurance in the 1950s and 60s meant Black families couldn't build the same financial security as white families, even when incomes were comparable. The insurance industry never apologized for this systematic discrimination, never acknowledged that their actuarial tables were built on racist assumptions, never offered to refund the excess premiums Black policyholders paid. They just quietly reformed their practices as legal and social pressure mounted, without admitting fault for decades of exploitation. Today, insurance discrimination based on race is illegal, but the legacy persists in subtler forms: zip code-based pricing that correlates with racial demographics, credit score requirements that reflect historical discrimination, occupational categories that track racial employment patterns. The language has changed. The mechanisms are more sophisticated, but the core dynamic, using proxies for race to justify differential treatment while claiming objectivity, remains recognizable. Nat King Cole paid $15 per year to Lloyd's of London for life insurance that cost Frank Sinatra $5 per year. That's not actuarial science, that's racial taxation. The insurance industry took the outcomes of systemic racism, codified them into actuarial tables, and used those tables to justify charging black Americans more for the same protection white Americans received as a matter of course. They profited from discrimination while framing it as neutral risk assessment. Nat knew what was happening. He documented it. He paid the inflated premiums because he had no choice, and he protected his family despite an industry designed to make that protection as expensive as possible. Maria received the $500, $0 payout when Nat died, but they'd paid $180, $0 in premiums to get it, $120, $0 more than they should have paid if Nat had been white. That $120, $0 represents the price of being black in 1950s America, even when you're successful, even when you're healthy, even when you're doing everything right. The insurance industry extracted that racial premium from Nat King Cole and millions of other black Americans who just wanted to protect their families, and they called it sound business practice. That's the story, not about Nat failing to get insurance he eventually did through Lloyd's, but about the systematic barriers he faced, the racial surcharges he paid, and the industry that treated black lives as inherently less insurable than white lives with identical profiles. Insurance is supposed to be about protecting against risk. But in 1950s America, being black was treated as a risk factor itself, and the cost of that discrimination was paid by families who could least afford it. Nat King Cole could afford it. He paid the racist premium, got the coverage, protected his family, but he shouldn't have had to, and millions of black Americans who couldn't afford Lloyd's of London rates simply went without protection because the industry that claimed to assess risk objectively was really just enforcing racial hierarchy. That's not ancient history, that's within living memory, and the wealth disparities it created compound across generations, right into 2026.